We thought it would happen in the third quarter, so it just happened immediately, and there's always different reasons for why it happens. Look, our general take on the correction that we've seen is that we're probably going to be stuck in this range now. I mean, we had a pretty big shock. It wasn't just the correction we saw in the equity markets, but then we had the carry trade kind of unwind, and I don't know how people can sit back and feel comfortable with that. The main thing, though, is what you guys have been talking about this morning, right? The consumer is slowing, right? All the consumer services companies in particular, it's not just the goods companies, and that has to be resolved here. So the way we think about it is, in order for markets to kind of make a new high, I mean, you need multiples to expand, and that's going to be very challenging in a world where growth is slowing. Okay, earnings expectations probably are still too high for the second half of this year, and a Fed that's reluctant to be proactive. Okay, and I don't disagree. People are criticizing the Fed. I'm like, well, look, they're just being data dependent. I mean, and so they're doing their job. They're going to react if they need to. If they overreact, then that probably exacerbates the carry trade problem. So they're not going to overreact.
Whether you think you're going to get that 25 or 50 basis point cut over in September, it's still more than a month away. Right. So as rates remain elevated, how much more pain does the consumer see? Do you think investors are perhaps underappreciating how much more pain there's left in the consumer?
Plus they're lagged, right? It's not like the Fed cuts at September 18th and the consumer goes to Home Depot and buys a new washing machine on September 19th, right?
Yeah. Well, that's generally been our view, right? I mean, we've been underweight consumer discretionary and sort of overweight the later cycle groups and then defensives on that premise, meaning we think being defensive right here makes a lot of sense for all the reasons you mentioned. All these things work with a big lag, and I completely agree. In fact, our note this week, we discussed this in detail, particularly housing. Right, 25, 50 basis points isn't going to do anything, mainly because most people's mortgage rates are sub 4, if not sub 3%. So you need 200 to 300 basis points of cuts to really get some of these interest rate sensitive areas moving, and that's just going to continue to weigh on consumer sentiment. It's going to weigh on consumer stocks, and so that's how we're set up. We're set up to be sort of underweight that space.
And Mike, I want to get your thoughts on some of the technicals here, specifically when it comes to positioning in the big tech sector, because there's a note out from Citigroup this morning saying that there's still $22.5 billion worth of long positioning on the NASDAQ 100. And in their view, that makes the index still pretty vulnerable here to any sort of sentiment shock, maybe at 8:30 a.m. tomorrow morning. What are your thoughts on positioning right now after the few weeks that we've seen?
Yeah, I mean, the faster money crowd has adjusted significantly, even the systematic strategies and some of the long-short community. But the asset owners, right, retail, long-onlys, that crowd is still very exposed. And so there is length in the marketplace. It's not just NASDAQ 100, it's kind of equities writ large. So the way we think about it right now is the valuation is just inappropriate, right? Valuation doesn't matter until it matters, and then that's all that matters. And we've been very adamant that 19 times is kind of a fair market multiple in a soft landing. Okay, so today we're north of 20 times still. So it's very hard for me to get excited about the index, which is why we're really focused at the stock level and the sector level to try and make money.
A little more on the carry trade here, because the carry trade is not really isolated to the yen. I think that's an important dynamic of this. The other important dynamic, I think, is how much investors didn't realize how much leverage was under the system. If you think about kind of what has left to unwind, these kind of exogenous shocks, do you still worry that there could be another one this year?
Well, there's still a lot of leverage in the system. I mean, so that I just sort of spoke about equity length is high, okay? Bond length is low. So, I mean, people are skewed to having more risk on. Then you take into account the leverage in the system through products like triple levered ETFs or daily expiration options, just the leverage in the system as people are doing carry trades of all sorts. Yeah, there's more leverage in the system than there should be, given the uncertainty still of the eventual outcome of the economic, events that are still in front of us.
Speaking of those, you said you expect earnings to be weaker in the second half. We've had an excellent earnings season in the second quarter. Right. I think 11% is what we've seen in terms of profit growth year over year. Why is the second half going to be harder? Do you think tough comps from last year? Do you think we're not going to see a continued broadening out of earnings growth?
So one part of it's expectation. So there's a big hockey stick in the fourth quarter, and there's been a lot of discussion around a pickup in orders in the second half of the year that continues to be elusive. So as we come into September, and we wrote about this week too, the key data for us is going to be what are companies saying in September about order books. If we don't see order books pick up in September, your year is kind of shot in terms of seeing a reacceleration that's now in the numbers. So we're open-minded. It could change. But I don't think it's going to be because the Fed's cutting rates. It's going to be perhaps maybe people hunkered down a bit, and now we can see a reacceleration. But the comparisons are difficult, as you mentioned, particularly in the fourth quarter for the Mag 7, and that's part of the story too. And so look, the key thing that we look at is forward next 12-month earnings growth. That is now peaking. And when that peaks, that means multiples come down. And that's as simple as I can make it. So 20 times to 19 times, that's our baseline. That would be kind of at the low end of that range we wrote about this weekend. And that would be a place where I would get interested at the index. That's still 4, 5, 6% away. And then if it gets worse than that and it gets cheap, then we'd get really interested. But that's like 17, 18 times.
And so tying this into some of the economic data that we've gotten in the past 24 hours, of course, we had the NFIB optimism index come out. That was good news. An interesting detail within it, though, if you take a look at the report, it showed that the share of firms planning price increases dropped to a net 24%. That's probably good news for the inflation picture, but I read that as basically these firms are out of pricing power.
Yeah. It's a really good point. And I think this is, be careful what you wish for on inflation. We've been talking about this for a while. You know, the market did sort of make its top. Okay, part of that was on a good, lower CPI number, and we wrote about that in early July. You know, weaker inflation data now is potentially bad news for stocks. Good news for bonds, okay? Bad news for stocks. Why? Because that's pricing power, to your point. And the PPI in particular is more aligned to revenue growth than even the CPI. So I'll be interested tomorrow to see if we get the same data point. You know, I'm not excited for stocks because inflation is surprising on the downside. I'm excited that maybe my trade in bonds looks better, and that's why we like defensive stocks. And I think that all kind of syncs nicely.